Hey, well, good morning, everyone, and welcome to the fourth installment of Anders 2025 Banking Webinar Series. Well, barring any late-breaking developments, this will be our final installment for 2025, so we'll look forward to seeing you all again next year. For those of you who are new to us, a very, very special welcome to you. We do these on about a quarterly basis, so please spread the word. My name is Brad Stumpy. I'm a partner and the practice leader for bank compliance and loan review services here at Anders. You'll notice nothing about tax in my title, which is why I'll be joined today by Brent McClure. Can you please wave to everyone, Brent? And
Morning.
also Rebecca Tucker. Thank you. Good morning, Rebecca. Brent is a partner and the leader of our financial institution tax practice, as well as our business transition planning tax practice. So he could be very helpful for you and possibly even some of your customers on a couple of different fronts. And I'm sure he'd surely be glad to talk to you about that. Rebecca is a senior manager in our tax practice who focuses on financial institutions and privately held businesses. So could also be very helpful to you or some of your customers on a couple of different fronts. If you tuned in for our webinars during the pandemic, Rebecca played a key role in helping our clients navigate many of the relief programs. So think PPP, EIDL, and the like that came out of that era. All right, done with the introductions. Before we get too far into this, I want to point out that you can download the slides from the chat if you'd like to have them handy during the webinar, and they'll also be included with the post-webinar materials. Those materials will be via email and will include a link to both the recording of the webinar, the slides, and then some other relevant information as well. That email will come out within the next few days. So if you don't have it by this evening, no need to email me and say, hey, Brad, where's it at? If you don't have it by this time next week, go ahead and send me an email and we'll get that out to you. So if you've been with us before, you know that we typically focus on something new in the world of banking, particularly bank compliance. But all of those new rules that we've been focusing on for the past few years have been, at least for now, put on hold. So we thought, one, we'd give you a break from listening to me for most of an hour. And two, we discuss some of the provisions of the One Big Beautiful Bill, or OB3, that might be relevant to a banking audience. Those of you who know me, know that I'll talk all night long about TRID, CRA, fair lending, EFT, BSA, and on and on and on. But you also know that when you say, hey, Brad, you work for an accounting firm, can I run a tax question by you? I will quickly defer to someone much wiser than I when it comes to taxes. And today, those someones are Brent and Rebecca. So I'll turn it over to the two of them shortly, but do want to make one final housekeeping note that, with right at 100 registrants today, so thank you all very much for that, but we won't be unmuting you to ask questions. That being said, we do welcome your questions in the Q&A feature. So please put those in the Q&A feature toward the top of the screen and not in the chat. Chats for the slides, Q&A features for the questions. We've also left some time towards the end of the prepared comments where I'll pop back on. I'll try to act like I know what I'm talking about and pose at least some of those questions to Brent and Rebecca. So with that, I think I'm done with the introductory comments and I'll hand things off to the OB3 experts. Brent, the floor is all yours.
Thank you, Brad. I appreciate that. I'm glad you have just as many acronyms as we do. So, Brad, I'm going to throw a challenge out there to you. I want you to come up with, since it's Halloween week, I want you to come up with your best Halloween joke to close the presentation. Now, I'm going to start out with one here, so please, everybody, bear with me. But here's my Halloween joke. So, why did the ghost get audited? He had too many phantom deductions. Now I can see everybody, visually see everybody's eye roll, visually see everybody's groaning. So I'm getting that out of the way. Okay, so let's talk about OB3. It was enacted in July 4th, 2025. I'm sure most of us were on vacation somewhere doing something other than thinking about tax law. It's the largest impact bill since the Tax Cut and Jobs Act in 2017, and most of those implications came about in 2018. It's effective immediately. Many of the enactments are going into effect in 2025, some in 2026. Scope was for individuals, businesses, and estate tax provisions, and it's a mix of both permanent and temporary provisions. So today's session structure, next slide, please. Today's session structure, we're going to talk about business tax. Rebecca's going to touch on the individual and estate. And then we're going to leave some time for some Q&A at the end and anxiously await Brad's Halloween joke. So who's affected by this? This impacts individual taxpayers, high tax state residents, families with children, seniors, service workers, vehicle purchasers, and then pass-through entities, small corporations, R&D companies, and capital-intensive businesses on the business side. The main impact of this bill was really towards the individuals. Next slide, please. Not much is new for the OB3 for businesses. It's mainly really an extension of the Tax Cut and Jobs Act that was done in 2017. However, many of these were made permanent. We're going to touch on the QBI deduction today, enhanced depreciation benefits, R&D expensing, qualified small business stock expansion, excess business loss limitations, business interest expense limitations, and then touch on the agricultural loan exemption for those in the financial industry. So QBI, qualified business income deduction. That is a 20% deduction rate. So for example, if you qualify for this, have $100,000 of QBI income, automatically gets reduced to $80,000, 20% reduction. They expanded these thresholds with the OB3 bill by $75,000 for single and $150,000 for married, and those phase-out caps at just short of $545,000 for married filing joint. They did throw in here, for some odd reason, a new minimum. So you get a QBI deduction of $400 on at least $1,000 or more of income, which is I'm questioning why that was done. I think it was maybe to get some small startup QBI businesses into this. Now remember, this is for pass-through entities, and it still has the wage and property limitation effect on those for SSTB. And for SSTB, what we mean by that is specified service trade or businesses, which is really consulting service-oriented businesses that are limited by that SSTB deduction. Capital expenditure benefits. Really, these are enhanced depreciation provisions. Bonus depreciation was ratcheted back to 100% immediate and made permanent. That is for those assets acquired and placed in service after 1/19 of 25. Why such an odd date? Everybody remembers that was the date that President Trump was put in office. So that's as of that inauguration date. We also have a new term here, qualified production property. That is really, for example, factories, manufacturing businesses, etc. In order to bring back manufacturing business into the United States, qualified production property constructed between inauguration date and the end of 2028 will qualify for 100% bonus depreciation. And if those are still under construction, started but under construction and placed in service before 2031, they also qualify for 100% bonus depreciation. Section 179 limitations were bumped up to $2.5 million maximum. I believe it used to be somewhere around $1 million. And then as long as you don't place in service more than $4 million of qualified property, you can take advantage of that $2.5 million maximum. It ratchets it down as soon as you place in service more than $4 million. And those figures are all effective for assets placed in service in 2025. So the question becomes, why wouldn't we simply just take either bonus or Section 179? And the answer is because some states do not couple with bonus depreciation, and couple with 179. For example, state of Missouri is an automatic coupling state. So for the state of Missouri, we would automatically couple with bonus depreciation and be eligible for that. State of Illinois does not. So we have to look at maybe possibly taking the 179 deduction for those clients in Illinois versus the bonus depreciation. Now, that is not to say that depreciation doesn't exist at all, because we still get to roll back to the makers or acres methods for depreciation on those assets. We also have to look at the NOL complications on this. A Section 179 deduction cannot push a company into a net operating loss for tax position, cannot push that below zero. However, bonus depreciation can. It can push us into a net operating loss. However, we got to do some looking at that too and say, well, if I've got a net operating loss, I'm only allowed to maybe take 80% of that for the following year. So there's some tax planning that needs to go into effect for both utilizing bonus and the Section 179. So the next slide is really the bonus depreciation percentage, and just a visual representation of where those were for the Tax Cut and Job Act, and then where they are for bonus depreciation for the OB3. And as you can see, it was up to 40% before inauguration date. After that, it's going to be 100% permanent after inauguration date. Research and development. I think one of the biggest changes of the bill was the research and development change. The old law, which started back in 2021, end of 2021, was to capitalize and amortize those costs that we used for the R&D credit. And why that was such a bad law, in our opinion, was you're paying tax on some sort of, and I'm going to use a Halloween term, some sort of phantom expense on this. Usually the credit was done with wages and maybe supplies and things that would normally be expensed. So it was, in our opinion, it was a bad law. Again, it was one of the biggest changes, I think, to the OB3 bill. So now that 100% expensing is back, and that is effective as of 12/31/24. We still get the option to elect to capitalize and amortize those costs over 5 years if we would like to still do that. The foreign R&D credit, however, is still at a 15-year amortization, and that will continue. There is an opportunity for our small businesses, those with under gross receipts under $31 million averaging for 22 through 24, still some opportunity to take those back and amend 2022 through 2024 tax returns. We have to do that, though, however, before July 4th of 2026. We get 1 year from enactment to do that. Next slide is really just an example on the cost and the detriment. And look at that difference column, the detriment of having to capitalize those costs. So if we, for example, if I've got a client that had $2 million of annual R&D costs, we had to capitalize those from 22, 23, and 24. You can see there's been a huge difference, a huge tax hit for those years. If we decide to go back and amend those tax returns, potential refunds of $882,000 come into play. That does not count towards maybe some state amendments as well. For example, Missouri would also be eligible for those credit amendments. So some R&D considerations we need to think about. Was it a flow through, or was it a C corporation? The number of shareholders or partners comes into play as well. Effective tax rates for those past years and those future years, and then the ability to utilize those any NOLs that we might create and carry those over into future years. Now, we also have we talked about the $31 million ability for gross receipts of those companies to flow back. There are some options, though, for those companies that are not eligible for that. We can do 3 things for those companies. One, we can take the remaining basis of our R&D capitalization, deduct those all in 2025. We can elect to split those between 25 and 26, or we can elect to just stay the course and keep amortizing, or keep amortizing those costs until they're completely gone for the next 4 or 5 years. So 3 options if we don't qualify for that under $31 million gross receipts test. Here's an actual example that we looked at with one of our companies. It was an S corporation. They fell under the $31 million rule for their receipts for the last 3 years. We looked at that, thought it was going to be a slam dunk. Hey, let's go back and let's amend all these returns. Well, for 2022, they had kind of a normal year. 2023 hit it out of the park with their net income. 2024 was a down year then for them. So we went back and looked at that and did the analysis and came up with about a $20,000 benefit for them to amend all these tax returns. Now you thought, well, 20,000 bucks back in my pocket, that's pretty cool. But what happened was with amending, having to amend 3 years of business returns for shareholders in the company. So that's 12 amended returns that we would have to do for 22, 23, and 24 for the individuals. And then the question of, boy, when are we going to get this refund? And as you might know, the IRS is shut down. So that was one of the big questions we had. And we talked with the client through this and decided that it wasn't going to be worth the squeeze of doing these returns, amending all those, waiting for only $20,000 when we know we're going to get the deduction here in 25 and 26 with this company. So we elected not to go back and amend those tax returns. So there was a bit of analysis done on that. So if we have any clients that have these R&D considerations, we need to make sure we're thinking about, hey, is it beneficial to go back, or is it beneficial just to keep going forward and either taking those deductions in 25 or 26. Next is the QSBS expansion, qualified small business stock. This was another big change. And what this is there's a gain exclusion that's available for those companies, C corporations have to be, for gain exclusion. The gross asset threshold was pushed up from $50 million to $75 million. And that is a test based on the gross assets before and immediately after the issuance of these stock. And those are assets held, such as cash, property, things like that. The old holding period was simply just a 5-year, 100% exclusion. No graduated from 3 years to 4 years to 5 years like it will be now. So they graduated it from 50% exclusion in 3 years, 75% exclusion at 4 years, and 100% exclusion at 5 years. Exclusion amount also jumped up from $10 million to $15 million. However, the 10 times shareholder basis still applies. And so it's a greater of either 10 times the basis or $15 million. And that is going to be started indexing for inflation in 2027. However, there is a qualified trader business clause in this where no health, law, engineering, architecture, finance, or consulting will qualify for this. So what we have to do with this QSBS expansion too is we need to, if we've got clients that are eligible for this, we've got to think about what type of entity structure do we want? Again, it has to be C Corp. Document those qualifications at the beginning to say, yes, we qualify for this, and then review possibly some capitalization strategies for those clients. Excess business losses. This is next slide, please. There you go. This is really a non-corporate part of the provision. Business loss limitations cannot or are limited now to offset non-business income. This was the one part of the provision that was really not taxpayer friendly as far as it goes for businesses. The rest of them are all pretty taxpayer friendly. This was made permanent. It was set to sunset after 2028. The one thing we need to watch out for is making sure that we're realizing that these are carried forward as net operating losses. So they're going to be limited to income as well. The thresholds are also now adjusted to 2024 basis. Those are right now at $313,000 for individuals and $626,000 for married filing joint. Business interest expense limitation. This was modified from being just for earnings before interest and taxes to modified to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And it was made permanent. So if you think about the calculation, it's going to allow us to deduct more business interest because you're adding back depreciation and amortization to your earnings before interest and taxes. So it's going to allow that business interest expense limitation to be greater. This has really a minimal impact on banks and financial institutions because most of the interest expense is offset by interest income. Usually banks are making more interest income than they are interest expense. So it's really not applicable to a lot of our financial institutions. Agricultural loan exemption, something brand new for the OB3. It excludes 25% of the interest income from federal tax on a new loan secured by qualifying rural or agricultural property. It does not apply to any sort of refinance loans. And those, the borrower must be a US-based entity or individual, so no foreign loans can apply to this. And then no mixed use property. In other words, it has to be substantially used for agriculture. Property will be considered rural or agricultural real estate if it's used for production of one or more agricultural products in the trade or business of fishing or seafood processing or aquaculture. And again, the provision is effective for taxable years ending after the date of legislation was enacted, in other words, July 4th, and before the end of 2028. We are still awaiting some IRS guidance on this to see if a substantial restructure of those loans would qualify. And then we also don't want to forget about the TEFRA allowance. In other words, the reduction in interest expense related to these loans. Some other provisions for business that were made permanent. Most of these are, you can see the list here, employer provided child care, new markets tax credits, qualified opportunity zones are probably some that fall into the financial institutions. ERTC, let's talk a little bit about that. We helped many clients with our ERC qualifications. Some we didn't feel were eligible for it. However, there were some clients that decided to reach out to other firms to get ERC credits. And what we are finding out is that they really did not qualify. The IRS guidance came out recently on that and was real specific on such things as government shutdowns, supply chain issues, closing of certain portions of folks' businesses, buildings businesses, things like that. The AICPA, our leading edge alliance, our insurance companies, and our legal folks that help us, in our firm and firms across the nation have really said, we cannot sign tax returns where we think the ERC was erroneously filed. It could also impact some of the financial reporting, and what we think we're going to see, pending the IRS opening back up, is when all these tax returns get filed in 2026, with these large increases of income or reduction in wages or whatever it might be with the ERCs, we're going to see a lot of 2026 returns probably audited. And with these ERC credit applications, the IRS gets 10 years to look at those credit applications. So it's something to be very, very cautious about. Another point I want to make before I turn it over to Rebecca is the IRS shutdown. We are on day 29 of the government shutdown. We've experienced no call center help. We've got a couple clients that are under audit that we cannot send anything to the IRS with those audits. Court dates, I think for the last 2 weeks, have been shut down. Paper filing, they're saying is going to be delayed a lot too. However, on the good side, they are still taking everyone's money. I guess that's something good. So they are still cashing checks. They are still issuing refunds if things were done electronically. If it's a paper check, those are also going to be delayed as well. So just a little bit of commentary on both the ERC and the government shutdown. And with that, I will turn it over to Rebecca to start rolling through some individual tax provisions from the OB3.
Thank you, Brent, and thank you has been said already, but thank you to everyone for joining us today, this morning, almost afternoon. I found a quick Halloween joke since Brent gave us the challenge. He gave Brad the challenge, but I'll take it too. Forgive me for this. What is the Haunted Bank's motto? Invest in bonds. Okay. Silliness aside, let's get back to OB3, OBBB as it were, and let's talk through some of the individual tax provisions. So a lot of things about the OB3 are directed toward individual tax situations. You can see a few of those listed on the slide right now. So while these all may or may not be relevant to you, I know that while you're working with your bank customers, some of these items may come up. They may also be applicable to you personally. So we wanted to run through what some of the major hitters are in this category to make sure that you're kind of aware that these are going on. Obviously, there's details to each and every one of these provisions, and there's more that we just can't get through in today's webinar. But again, just kind of giving you an overview of what some of these major items are. So the first couple things to call out here are individual tax rates. So the tax rates in the left side column there, that when the TCJA was set to expire at the end of 2025, we would be going back to the rates in the left column. The OB3 in the right column kept the rates as we've known them for the last several years. There's also numbers that are not included on this slide about when the next tax bracket comes into play and such. Overall, the OB3 and keeping with what rates have overall been lower and more favorable to individuals. The trust and estate tax rates have also been kept in place. So both of those rates are remaining the same. If we haven't said it yet, the definition of permanent throughout this entire discussion today is permanent until the next change. That's how tax law works. So with what we've got right now, these individual trust and estate tax rates are permanent going forward. We'll also touch briefly on the standard deduction. So this is another item that was set to expire at the end of 2025, meaning that this upcoming January 2026, we would be looking at the column in the center, lowering the standard deduction to about half of what we've known it to be the last several years. So another good news, OB3 is keeping the standard deduction as we've known it for the last several years in play going forward. Now let's talk about some of the things that are changing. So SALT. SALT is the state and local tax, SALT, deduction allowed on Schedule A for those who itemize your deductions. So the last slide was standard deduction. This one is about itemizing deductions. One of the big changes that the TCJA put into play for individuals several years ago was a limitation on this SALT deduction, that rather than deducting all of the SALT taxes paid in a given year, we were limited to $10,000. There's a caveat now where there may be opportunity to take more than $10,000 deduction for the next several years. The new cap will be $40,000, and it all comes into play with income. So we'll walk through a couple examples here in just a minute, but for years 2025 through 2029, we may have the opportunity, again, for those who itemize deductions, to take a greater SALT deduction than we've been able to for the last several years. One item to note, pass-through entity tax remains. So the PTET, as it's affectionately referred to around the office, pass-through entity tax kind of came about as a result of the SALT limitations that were put in place with TCJA several years ago. Hopefully that was enough acronyms for you in one sentence. But the advantage of electing into or having a pass-through entity tax pay that PTET on behalf of the individual partners or shareholders is generally still the more beneficial route. If you're not sure with your particular situation whether you want to continue to elect, or if you are the partnership or S corporation, whether you want to elect to be paying that PTET, of course, your Anders advisor would be happy to take a look at that with you. But generally speaking, still electing into the PTET when we have the opportunity to is going to provide the most benefit to us. So let's talk about some of these examples. So we're going to use Billy and Lily as our example today. Billy and Lily are a fictional married couple. They paid $40,000 or more in SALT, so they are eligible for up to the maximum $40,000 deduction. In this case, their income is $450,000, which means that it's under the limit, so we can take advantage of the full $40,000 in scenario one. Tax savings at a 35% tax bracket are $14,000. In example two, we have the same amount of SALT paid in. Income in this case is over that $500,000. We're now at $550,000. We've done the math for you. The SALT that we can deduct in this example is $25,000, so not the full 40, but more than the 10. And the tax savings at a 35% tax bracket on that $25,000 deduction is going to be $8,750. In our third example, same Billy and Lily, same $40,000 in SALT. Income is now $600,000. This is at the top of the range of the phase out. So the least cap that we can deduct is $10,000. So we'll take $10,000 on our Schedule A, our itemized deductions, and in the 35% tax bracket, we'll see a $3,500 federal savings on that deduction. Another change to itemized deductions, pardon me, is mortgage interest. So the key here is that under the TCJA, we had previously, before TCJA, been able to deduct mortgage interest on indebtedness of up to $1 million. Now, during the TCJA, it was limited to $750,000. So we were more likely to run into or be able to deduct less mortgage interest with this cap on the indebtedness amount. That was set to revert back to the $1 million threshold, but the OB3 made the $750,000 permanent. So we're still under the same rules that we've been working under for the last several years. Another ticket here is that mortgage insurance premiums can also be treated as mortgage interest. So again, if we're itemizing deductions, whether we are limited, we can also consider deducting some of those mortgage insurance premiums. Another change to itemized deductions, but this one, there's also a piece of it that could impact those who take the standard deduction. So for those who are itemizing deductions, starting in 2026, there is going to be a new floor of 0.5% of AGI on that deduction. So when we look at our Schedule A itemized deductions, we've got the SALT category, we've got mortgage interest, and we've got charitable contributions. Our charitable contributions, we will start with what we paid in qualified charitable contributions during the year. We'll take out that 0.5% of AGI, and then what's remaining could be deducted on Schedule A. We'll walk through an example of that in just a moment. Those who don't itemize deductions, those who take the standard deduction, will have the opportunity to take a deduction, $2,000 for married filing joint or $1,000 for single filers. This must be cash donation. So for those who've maybe been in the world of taking the standard deduction, because again, we've got that higher standard deduction, those who've been in that world for the last several years, and you haven't been tracking your charitable deductions, starting in 2026, if you're putting, giving some cash into qualified charities, there might be an opportunity to take a tax benefit for that. So maybe it's time to start tracking again those charitable contributions. Another item to think about here with the new floor for those who are itemizing, since this comes into play in 2026, there are a couple avenues to consider. One being that we have the last couple months of the year here to plan for 2025 charitable contributions. If we have some big charity that we know is coming up in the next several years, it may be a time in 2025 to make those deductions, sorry, to make those contributions, take those tax deductions, or maybe we're ready to take the deduction, but we're not ready for it to go off to the charity just yet. Maybe we have a schedule in mind or whatever that's going to look like, agreed upon with the organization. This may be an opportunity to look at something like a donor advised fund. In a donor advised fund, we get the deduction in the year that we contribute to the fund, and then the fund will hold those investments, whether cash or securities, until that is paid to the charity in a future year. When it's paid to the charity in a future year, there's no longer a personal tax benefit. So the benefit comes into when I'm putting the funds in the investments into the fund. So again, kind of comes down to tax planning strategies, what 2025 looks like, what the next several years maybe look like in your situation. So let's walk through an example of how this new floor is going to impact charitable contributions. So Billy and Lily in this example have AGI of 400,000 and they made deductible charitable contributions of 20,000. We're going to calculate 0.5% of that AGI, which is $2,000. So now our deduction that we can take for charity is 18,000. In the 35% tax bracket, that is a tax savings federally of $6,300. Another item here that is going to impact those who itemize deductions and those who are in the 37% tax bracket. So this is the highest tax bracket. This calculation can get a little convoluted, but don't worry about that. The idea here is that there is not a deduction in some regard for the difference between the 37% and the 35% tax bracket, which is right before it. So there's that 2% difference. So the calculation will come into play as a 2 over 37, 2/37 of our itemized deductions that will no longer be deductible when we're in the 37% tax bracket. This is a new limitation. We haven't seen this type of this exact calculation before. So again, this starts in 2026. So now's the time to start planning for it. The way that we're going to work through this calculation to take the best advantage for each taxpayer is through charitable contributions. So I mentioned before, our SALT deduction is going to kind of be what it's going to be up to the maximum. You know, we've got our caps. Mortgage interest is going to be what it's going to be, what we paid in mortgage interest. And then whether it's limited or we can take the full amount, that's going to be what it's going to be. So charity is where we have the wiggle room to make up the difference in the 2/37. If we're planning for a certain amount of overall itemized deductions in a given year, and we know now that we're going to have this extra limitation, this extra non-deductible portion of our itemized deductions, charity is where we'll be able to make up the difference for that to get to where we were planning for in itemized deductions. So if we walk through an example, and this will be a high-level example for Billy and Lily. They are in the 37% tax bracket this time. They have AGI of 700,000. Their itemized deductions are made up of $10,000 of SALT, $10,000 of mortgage interest, deductible mortgage interest, and $80,000 in charity. So now that we have these two new limitations, we're going to start with the 0.5% of charity that's been disallowed. That will be 3,500, so that's 0.5% of the AGI. And then we did all the background math on the 2/37. That is going to be an additional disallowed itemized deductions of 5,216. which leaves our deductible itemized deductions. Rather than the 100,000 that we started with, we can deduct 91,284. So in the 37% tax bracket, our tax savings on that 91,000 is 33,775. So you can see here how these come into play. And like I said, there's a lot more detail to all of this, but this is kind of one of those opportunities. If you or your customers are in the 37% tax bracket, they probably need to be thinking about this and planning for this. Both the 0.5% for charity and this new 2/37 itemized deduction limitation come into play in 2026. So let's plan for things in 2025 to prepare for 2026 and going forward. Another deduction. So this is not an itemized deduction. Excuse me. This is available for all who, meet the requirements. So this is applicable for years 2025 through 2028. There is a maximum potential deduction of $10,000. A few items to note. Excuse me. There's a phase out beginning at 200,000 married filing joint. Modified AGI, or 100,000 for single filers. Indebtedness for this vehicle must incur after 12/31/24. So it must be a vehicle where the loan started in this year or for the next several years. Final assembly of the vehicle must have occurred in the United States. You must be the first user of that vehicle. If we can check all of these boxes, then we have this additional potential deduction. So what might that look like? Let's look at an example. Billy and Lily, in this case, have $150,000 in AGI. They paid at least $10,000 in vehicle loan interest. Off screen, I already checked off to make sure that they fit all the other qualifying factors. So they are looking at, in the 22% tax bracket, $10,000 of a deduction, tax savings of $2,200. So the vehicle loan interest is one item that I would say don't feel the need to go out and purchase a new vehicle just for the sake of the tax deduction. If this is something that you were already considering, there may be a tax advantage to it. Let's talk about some senior and family tax provisions. So we are looking at potentially a significant benefit here to seniors. Senior taxpayers have the potential to deduct an additional $6,000 per taxpayer. This is for taxpayers who are ages 65 and up. There is an income phase out. You can see the dollar amounts there on the screen. So this is through years 2028. So this provides a lot of opportunity for planning. If we were considering Roth conversions, it may be worth matching the Roth conversions either with the timing of the additional tax deduction here, or planning some of those Roth conversions either during that time or maybe foregoing that Roth conversion because we'll have this additional deduction. So again, there's some planning opportunities here to consider just how this additional deduction can be taken advantage of. It's a 4-year benefit. And like I said, this could add up. So for married filing joint seniors, this could be an additional deduction of $12,000 on a return. So we like to see it, and we like to see it for our seniors. We have another item under this category for Trump accounts. So the Trump accounts is kind of a new idea. These new Trump accounts are similar to an IRA. This will be for children who are born between 2025 and 2028. Under the pilot program, the government will deposit an initial $1,000 to start this Trump account. Accounts will start 1/1/2026, and then every year beyond that, the annual contribution can be up to $5,000. So this is an opportunity to invest in these children that they can have this account waiting for them. There's still some guidance missing that we need information on how exactly this is going to play out. But essentially, it'll look like tax deferred growth. One thing to note is that in that $5,000 annual contribution limit, if 2,500 of that goes straight from employer to the account, then that 2,500 does not hit the taxpayer's taxable income. So there's the opportunity there to get a tax benefit on some of those contributions in a given year as well. The child tax credit has been enhanced yet again. So pre-TCJA, we had $1,000 in our child tax credit. This was available for children under age 17. What it has been since TCJA is about $2,000 per child. So the new amount starting in 2025 is going to be $2,200 per child. So it's in the same vein as it has been, but it's also now going to be indexed for inflation. Previously, it has not been indexed for inflation. So we like to see that this will also be evolving as costs and everything else continue inflating as we go along. There is a potential for a refundable portion if you're in a lower tax bracket in 2025 and going forward. The child tax credit was made permanent, wink. There is a phase out based on income levels there that you can see on your screen. The example that Billy and Lily have given us for the enhanced child tax credit, if they have AGI of 150,000 married filing joint, they are under the phase out limitations. They have 2 children, so the maximum child tax credit for 2025 is going to be $4,400. A couple quick notes, and then we will get into some Q&A if there's been any entered in the chat here in just a bit. Credits that are set to expire. So the first one on the left expired. That one's over with. Clean vehicle credits and commercial clean vehicle credit. The credits were set to expire at these dates sooner than they were kind of registered to expire. The thing to remember with especially the vehicle credits, since that's passed, but also with the energy credits that are on the right side here that expire at the end of 2025, is that the purchase must be fully paid and must be fully installed to be eligible for the credit. So if we were 90% of the way there with that vehicle, or if we don't expect to be 100% of the way there with both the payment and the installation by the end of this year on the energy credits, we need to be aware of that and to plan for that. If you had all of that taken care of by September 30th, we can consider that credit, vehicle credit. And if you are in the midst of, or we're thinking about taking an energy credit, residential home credit, we need to make sure that that takes place, that that all happens according to the rules, and that that all hits by December 31st, 2025. We all know that things in the construction world can take a little bit longer than we'd like. So if we're in the middle of a project, we need to do what we need to do to make sure that we keep moving on that if we're looking to take that credit. A couple items here that the rules are essentially the same for these next 2 provisions, but they're just a little bit different in application. So the first one here, these are employment provisions. This one is for tips. So for service industry workers who have AGI under the limitations listed on screen, there's a potential to have a deduction for up to $25,000 of that tip income. Excuse me. So the key here is whether you are a person or working with folks who are receiving tips, or if you're on the employer side and maybe you're paying tips or talking to folks who are on the employer side paying tips, this is a record keeping requirement on the employer. So I believe for 2025, the W-2 reporting information is not necessarily changing, but it will be important for employers to provide the amount of tips received and earned to those employees along with W-2 and end of year tax information. This provision is temporary. It only goes through 2028. Couple examples. In example 1, Billy and Lily have $250,000 of AGI, so they can take opportunity deduct up to $25,000 of tips exempt from income. So that's cool to see. And in our next example, now Billy and Lily have a lot more income. They have $500,000 of married filing joint income. So we worked through the math, and here they'll be able to exempt about $5,000 of tips from their income. The other employment provision to discuss today is overtime. So again, some of these factors, AGI limitations, the dates that it's eligible through 2028, those sorts of things remain similar to the tips, but overtime do not have to be in the service industries to take advantage of. Again, the record keeping requirements fall on the employer to provide this information to employees. So we'll show you the examples that we've got here for Billy and Lily. The numbers work out to be the same because of the way that both of these provisions were created, again, with those similar numbers, but another opportunity to have a deduction or have some of that income exempt from taxes. Real quick, let me show you some of the other provisions for individuals that we're not going to go through in detail today. We talked a little bit about the PTET and that it's remaining permanent, that there was no direct change to that. Several of these other items on here, and again, it looks like they were all made permanent, and there were maybe some other changes about like when they were made effective or if there was a little bit of a change here and there. Let's talk through real quickly on estate tax provision. So estate tax exemptions, including generation skipping transfer tax. These are for our high net worth individuals who are looking or need to be looking at tax planning scenarios. So at the end of 2025, we were expecting to see that the old rules were going to come back into play. So we've been living under this exemption of about 15 million. This number is indexed for inflation. So I believe it's been about 14 million during this year. Double that, of course, for married couples, but the rules were set to go back, which meant that if you were in that window of having, while the rules were higher, while the exemption was higher, maybe you didn't have a taxable estate, but if they were going down, now we would suddenly have a taxable estate. So the OB3 was favorable to our high net worth individuals in this case, that the exemptions remained what they've been for the last several years, and again, permanent until further notice, but we are glad to see that those are remaining at a higher level. A couple things to note: this doesn't mean we don't need planning, estate tax planning. We absolutely still need estate tax planning. This just may have taken the urgency away or taken it down just a notch because we didn't have the pending drop at the end of this year. And another thing to note is that states don't necessarily follow the same rules. So if our taxpayers that are in this situation are in a state or have assets in a state that has its own rules, we still absolutely need to look at tax planning opportunities for those individuals and for their estate. We will just skip past the next slide. That's just got a bunch of numbers on it that we kind of already talked through. So some action items, we've kind of talked about these. Brent and I have both kind of referred to these throughout the discussion today. What to do right now? We've got 2 months left in 2025. What do we need to do? And then long-term planning, looking into 2026 and in future years, how do we plan for what the changes of the OB3 have brought to us? So from here, I'm going to hand it back to Brad to see if he's got any questions for us, if any have been added to the chat.
Wonderful. Thank you very much, Rebecca. Good stuff. So question for Brent. Am I limited to one Halloween joke? I've been at dad jokes almost as long as I've been at compliance. So we'll give Rebecca a chance to take a drink and catch her breath. I've got a question for you, Brent. For the agricultural loan exemption, does livestock production fall under that exemption?
Yeah, yes, it does. Livestock, dairy, poultry, fish, as we talked about, and of course, crops. So yes, it does. Uh, agricultural production is blanketed with anything that you really need land to produce.
Wonderful, thank you. So just to get my joke in before I forget, and to kind of stick with the theme, um, why don't witches need accountants? Because they always fly under the IRS's radar. All right. Rebecca, we do have a couple that I think would be for you. Appreciate the reactions. Do both senior taxpayers have to be age 65 to take advantage of those new senior tax provisions?
I don't believe so. I believe that the additional deduction will apply to one taxpayer or the other. So if one taxpayer is over 65, but they're within the income limitations, then we get that one extra deduction. If they're both over 65 and fall in the income limitations, then we can take two. So we can take up to $12,000.
All right, very good. Thank you. Hey, I got another joke. So I got a wife, I got a daughter, I got a couple sisters in education. My daughter's an English teacher. Here's your hint. What is a witch's favorite subject in school? Spelling. Oh, I love it. I love it. Um, Rebecca, I think this one would also be for you. So, what about if you have a child age 18 or over who still lives at home and the poor parents are still paying for everything? Can the child tax credit apply to them?
That is a fair question. I believe the rules around the child tax credit are they must be under age 17. So even if they're over 18 living at home, they're not eligible for the credit. They must be under 17 in order for you to take the credit on them.
That under 17 or 17 or under?
Good question. I think it's under 17, Brent.
I think that's right. I think it is under 17.
All right,
Mhm.
we'll go with that.
17 are cuspers.
There's plenty of those. So Brent, here's one for you. So bonus depreciation and then the 179 expensing election. Is that you have to choose one or the other, or is there a way that you could utilize both of those?
Yeah, you can utilize both of those, and it's as ordered. 179 comes first, and then bonus comes next. And so there's some interplay on, okay, do I want to take 179 and then bonus the rest, and then maybe not bonus some? So there's a lot of elections that can happen, and we don't have to make those elections until we file the tax return. So you also have to remember there's some interplay with the net operating loss. So Section 179 cannot push you into net operating loss. Bonus depreciation can, but then that net operating loss gets carried forward, and it's only limited to 80% of current year income for whatever year it's carried forward to. And then again, we also have to make sure there's some interplay with the states as well. Some states couple with bonus, some states don't. Some states have their own separate Section 179 limitations. So there's some planning for the states as well.
Very good. Thank you. Rebecca, I think this one would probably be more towards you. What are some items for employer to keep an eye on with these new changes?
It's a good question. I think specifically from an employment perspective, the key things that we talked about is record keeping for employees who are receiving tip income or employees who are receiving overtime income. The requirement to provide that information to employees falls on the employer, so they need to be prepared for that. There's also with the new Trump accounts. The potential, it must be in a written plan, but there's the potential to have the employer put 2,500 of the 5,000 annual limitation, put that contribution in directly into the Trump account on behalf of the employee. And then that 2,500 doesn't hit the employee's taxable income. So that will, I think I said that starts in 2026. So that will be an opportunity to benefit the employees and something that the employers can prepare for. Again, that written agreement, having that set up and structured to take advantage of that tax benefit for the employees.
All right, very good. And we had another one come in. This has to do with vehicle interest paid notices. So I'm guessing that's coming your way again, Rebecca. Congratulations. It says interest can only be deducted if the client is the first purchaser of the vehicle, question mark. So that's a question. And then also, does the vehicle have to be made in 2025, or could it be a 2024 model but purchased in 2025? So a two-part question.
Great questions. With the vehicle loan interest, and forgive me, I'm just going back up here on my notes. With the vehicle loan interest, if you are the first user, I don't think that it has to have been a 2025 production. I don't think. The indebtedness has to have occurred after 12/31/24, and the final assembly must be in the US. But I believe that even if the vehicle is a 24 model that was purchased in 25, as long as you're the first user, I believe that that would qualify. I'd have to look into the details a little bit more, but I believe that that would qualify.
All right, that gets us most of the way down the road for that car.
I caught that.
And we're right there toward the end of time. So I got one other. Here's a question from me. So I've got a grandson who was born last year in 2024. I guess he's out of luck on the Trump accounts.
I do believe so. Congratulations on the grandson, but I
Right.
don't believe he'll get the Trump account.
Thank you very much. All right. So with that, I believe we have reached our hour, and we sure do appreciate everyone joining us today. And thanks to both Rebecca and Brent for all their knowledge and insight. I know I learned plenty. If any of you have further questions, here's the phone number for our office, the website. You can always go look up more on Rebecca and Brent, get their bios off of that, their contact information, and we'd be happy to answer any questions you have. On the compliance side of things for banks, feel free to reach out to me. On the tax compliance, that's going to be Rebecca and Brent. But again, we'll be doing this again next year. So watch for the emails, the LinkedIn posts, all that, publicizing those coming webinars. And I'll leave you with one last Halloween joke. Since here in the Midwest, it is now lunchtime. What do skeletons say before eating? Bon appetit. And with that, thank you all very much, and we'll see you next time. Bye now.